So if the Dow stayed exactly where it is, which I doubt in nominal terms, gold would need to go up. It's 10.62. So to go sub 1, it would need to go up 11 times from here. 11 times. You're at 4.5. That's over 44,000. You know we're going to be talking 50,000 gold when that happens. However, if the Dow halves and takes half of that 11, then you only have to go up 6.5 times because it's half. No, it hasn't even started. Haven't even started. We're going a lot higher, a lot further. That's why I'm the silver messiah. And silver goes to the single digit. I think it could even go 3, once it's gone single in a blow off moment, because you just don't start mines that fast. We're going 4 digits silver. I think you could have, you're going to drop 9.99. That's when I'll start stepping back, buying more silver.
As the gold and silver markets hit explosive new highs this week, with gold shattering the $4,600 mark and silver surging past $90, the financial world is on high alert. A rare alignment of central bank hoarding, an unprecedented investigation into the Federal Reserve, and a tightening supply squeeze has created a perfect storm for precious metals, with analysts now eyeing a rapid climb toward $5,000 gold and $100 silver. The window to position yourself before the next parabolic leg up is closing fast. In this video, we sit down with FrancisHunt, the market sniper and silver messiah, who argues that this rally hasn't even truly started. Analyzing the Dow-to-Gold ratio since 1913, Hunt predicts a massive pump and dump cycle that could lead to 4-digit silver and $50,000 gold as the traditional financial system fails. He explains why current mining constraints mean supply simply cannot keep up with surging industrial demand. Is the death of equity closer than we think? Stick around to see the exact chart levels Francis is watching before he rotates out of the market. But before that, don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
This is the Dow Jones divided by a gold ounce. Since 1913, the Fed was created here. The Fed was created here. That's your pre-Fed stability. Dow Jones and gold ounces. Since the creation of the Fed, bang, you went to 18 ounces of gold to get the Dow. Then you crashed to 1.9. Then you pumped to 28. Then you had the huge stagflation, the Vietnam War. You did this halfway, hit the splitter, the midpoint here. You did this halftime rally and then dump. That was gold going to, listen to it, 1981 highs. Then they removed, because of Nixon in 71, somewhere over here, they removed the dollar being on the gold standard. So now they had gold where they wanted it, and we did the financialization of everything. Stocks and housing, pumpity, pump. 44 gold ounces at this point to buy you 1 basket of the Dow. Then suddenly, after 99, Brown's bottom, 2000, 2001, sold all Britain's gold, changed the name on the clipboard, stole it from the citizens, gave it to banker mates that put him in power. Guess what happened? You sold off down to here, 2011, the subprime crash. Terrible, very strong for gold, terrible for fiats, QE, you name it. You got your rally when they had 2011 and they eventually broke the downtrend. Then you started your half time, you met your half time, and now you're starting to move down. It's a bigger version of what happened here. It's a bigger version of what happened here. You're going here, you're going below 1 gold ounce to buy you a basket of the Dow. Well, right now you're at 10 is required. Don't forget you're at 44 up here. So you've already done a large part of that move. But in log scale, this is a log scale chart, percentage terms, it's huge still to go. So if the Dow stayed exactly where it is, which I doubt in nominal terms, gold would need to go up. It's 10.62. So to go sub 1, it would need to go up 11 times from here. 11 times. You're at 4.5. That's over 44,000. You know we're going to be talking 50,000 gold when that happens. However, if the Dow halves and takes half of that 11, then you only have to go up 6.5 times because it's halved. If it loses 70%, who knows? But I foresee Newsweek running the death of equity articles covers on their future magazines, and the cult of gold, the cult of this, and whatever, and many other things. So that just shows you. And by the way, that's the Fed stability that they introduced. Here's 1913, reminder through there. And this is the pump and dump, total stability. Of course, who's on the long side and knows when they're going to be doing liquidity provision and is long and short all the right assets? You can guess it. Who's getting a shave every time? You're crazy. And when they need a pump up, blow off top, and they need to bring retail in for the final high, you're being set up to be sheared, and that it's going to fail. People aren't talking about gold and silver right now. They aren't talking about it at all. It's almost meaningfully. You get a little bit of mention, but it's almost, it's got to be near a top right now. It's always to say, well, that's it. It's done well, but, no, it hasn't even started. It haven't even started. We're going a lot higher, a lot further. That's why I'm the silver messiah. And silver goes to the single digit, and I think it can. It could even go 3, once it's gone single in a blow-off moment, because you just don't start mines that fast. 60-70% of production is byproduct. They aren't down there for the silver. They're down there for the zinc, the copper, the gold, the other items. They're just getting it while it's there, if it's lying around in small numbers. How do you boost that supply? You don't. You can't. They're not there for it. They're choosing to dig a hole there for zinc, not for silver. That might, it's just incidental. They pick some up. You're going to need much higher prices for grades that are reducing to be worth getting. And the only thing that fixes it is price. And you've got the ECG, the whole battery and agenda that BlackRock brought you. People don't hate BlackRock enough. You've got that whole agenda that's still in the West made it very hard. Places like Canada and various other places. Permitting takes ages, etc., etc. How do you fix supply issues with that? A very long time and much higher prices for what's around. So we're going 4 digits silver. I think you could have, you're going to drop 9.99. That's when I'll start stepping back, buying more silver and maybe rotating out of the silver side of things.
Beyond the price action, FrancisHunt exposes a deep structural shift where industrial anti-fiat demand, not retail hype, is driving the current silver surge. Hunt argues that we are trapped in a hyper-stagflationary cycle where fiat and debt are essentially the same asset, leading to a massive loss of confidence in the system. He reveals that, unlike gold, silver is being physically consumed by next-gen technologies like solid-state batteries, creating a twin-turbo effect of supply shortages meeting desperate industrial needs, as retail investors remain wrecked by fake inflation statistics and rising costs. The real question remains, will the big institutional players trigger the final parabolic squeeze? Let's hear directly from FrancisHunt.
People who buy stocks are a different group of people than industrialists that need silver. So where's the demand coming that's driving the silver price? This is not a retail silver squeeze the bankers thing. Retail is a small component of this, and they've done margin increases. And by the way, key point on that, margin increases have put more pressure, upward pressure on the price, not downward. And I'll explain that in a bit if you want me to drill further on it. But anyway, let's park that for now. So this is a desperate producer-driven, physical demand-based bull market. It's not a, hey, all the libertarian, free us from the Fed guys are using leverage to squeeze the banks. The effect is the same, but it's not being driven by us. It's not being driven by anything apart from people don't consider themselves to own silver truly unless they've had it delivered and it's under their control. And there is a loss of confidence in the system. This is a confidence-based crisis and trust in the system. The fiat and the debt is debasement, one of the same, fiat and debt. They're not separate assets. One is fiat later and one is fiat today. We're in a debasement cycle. And when I draw these silvers in that parabola, the debt debasement is in this parabola, and you end up, when you add the two lines, with gold that holds value. You add them two together. So the one parabola that is inverted is causing the other parabola that is normally ascendant. And that's where we are. And silver is the anti-fiat. We've used and coined the phrase. I don't. One or two people copied us once or twice, but I don't see it gaining any traction. But it's the best way of saying it. There's a fiat and there's an anti-fiat. People can do it with religion and have a Christ and an antichrist. I don't see why they can't do it. And I see it very much in the same spiritual kind of war, if you'll excuse the analogies and the topic drift into all sorts of other areas. But the anti-fiat are precious metals. Gold is the king anti-fiat, silver is the queen, but the queen actually gets consumed and has a physical delivery issue. Gold can be recycled, and there's a lot of it stored in bullion. So we're getting a turbo on top of a turbo. Gold is the turbo and the king of the turbo. Silver is the twin turbo because it's got the production shortage to the consumption. And every new tech that they want us in that is battery driven, all the reasons for making it more efficient, like the solid state battery. So, there's so many drivers, silver's going to run. Your question was, why miners not so much yet? Because retail is wrecked in terms of investment. We're in a stagflationary environment. We're going to roll into a hyper stag, the extreme version of it. You've been a sustained recession in and out if it was truly covered with real statistics, not the fake employment and the fake inflation numbers that you're giving. You've been told that consumption was good. Well, that's in increased expenditure. Well, that's on the fact that the dollar buys you much less. If your grocery shopping cost you 5 years ago, $350 for you and your girlfriend, and it now costs you $600, you are spending more. GDP has gone up. Well, that's a bad measure if you're not adjusting it fully for the inflationary effect. So we've said the grand lie of inflation. So your retail investor is wrecked. That's who's not being able to get in there on any grand scale. Then you have to think about the big guys and the institutions.
In a world of pump and dump cycles and systemic debasement, FrancisHunt warns that we have reached the end of a 45-year debt supercycle. As the bond market top signals a massive liquidity contraction, Hunt looks toward a full reset, where precious metals emerge as the only surviving truth. This isn't just a trade. It's a generational shift from paper promises to physical reality. Are you ready for the day when the gold-silver ratio collapses to single digits? Share your thoughts in the comment section below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.